Good morning, happy Sunday, and welcome to this week's Top-Down Review. My name is Jeffrey Scott, and I've been doing this for about 20 years. And my email address, if you have any questions, is hgsidoc@gmail.com. I titled today, Markets Grind to New Highs. Interesting week, indeed. Get this set up. All right. For those that are new, if you're watching this on YouTube, there's a gear in the lower right quadrant of your screen, lower right corner. If you click on it, you can change the resolution. I record this in 4K. I actually have a 5K monitor, but I dummy it down to 4K. And you don't want to watch it in standard definition. If it's blurry, then give it time. It takes a while for the HD feed to upload and be processed. There's those thumbs up and thumbs down. Somehow I think if I get enough thumbs up, YouTube starts to distribute this a little bit wider. Right now I have no distribution. This is all word of mouth, and hence don't have that many people watching. I put a lot of work in. It would be worthwhile to have more people pay attention. I don't do this for money, but I do enjoy helping people. What else could I tell you? I guess that's it. We'll go ahead and get started. Oh yeah, if you have comments, please put them in the remarks. Email me. And I take good or bad. The only time I ever got upset at remarks is when people got mad at me because I whistle sometimes when I breathe during allergy season. So just be forewarned, if that's you, don't watch the rest because it's allergy season. Disclaimer, this is for educational purposes only. Anything I say should be taken in the spirit of education and not investment advice. I am a doctor, not a broker. I am independent. I pay for all the tools that I use, and trading involves risk. You and you are solely responsible for any investment decisions you make. A lot of folks make comments that I make this seem so easy. How did I get to be this way? I can tell you is what I tell my son. It takes work. It takes education. I learned from a master, Ian Woodward, who was influenced by O'Neill. And he used to tell us in his English accent that I could never reproduce. Jeffrey, I'm not the guru. I teach you to be your own guru. And I took that to heart. I think all of us need to rely on one person, and that's yourself. And you get to rely on yourself by becoming an expert yourself. No one has to be the next Mark Minervini or John Person or Van Tharp or O'Neill or Catcher Morales, but all of us can be a little bit of them. And I found that by reading prolifically, going to a lot of investment education meetings, meeting smart people like Sagar, Roy Kelly, John Person, Ron Brown and Ian, my buddy George Lee, made me a much better trader. My style is my style. Your style is your style. But hopefully you can learn something from what I do, or at least get some validation that your thoughts on the market are aligned with mine. Not that mine are necessarily correct. I own a lot of software. If you work for me or with me, just ignore the next few comments. But because I work full time, I run a company. I'm on the executive team of a healthcare technology company. I've been on the entrepreneurial side of medicine since 1998. Before that, and sort of concurrent with the beginning, I was in practice. We have about 3,500 employees, so I really do work full time. But because of COVID, I've had incredible returns, mostly because I'm sitting at home all day, and a couple of my screens will have TradeStation and Thinkorswim. Now, I don't care. I can use both of them. They both have their benefits. The radar screen and TradeStation is my favorite. The order entry is so much easier in Thinkorswim. In fact, my favorite order entry is on the mobile version of Thinkorswim. But regardless, I have the same indicator sets on both. I have some that I ported from HGSI. I have John Person set. I have Sagar's Q tools on TradeStation and Metastock, which most people probably don't have that listen to me, and then Dr. K's stuff. From time to time, I'm going to bring people in to talk to you through my narrow channel of distribution, but I'm never paid by them. I always ask if they're going to give me a fee when you purchase something just to give it to you as a discount. So I'm truly unpaid volunteer. This is just education, and I am not a trading professional as per the terms of the NYSE. HighGrowthStock.com, again, no financial relationship, but this is the heart, the nucleus of my trading day. Free 30-day trial, no credit cards are even required. In addition to that, under investing strategies, you'll see hundreds of movies. Now, one of these days they're going to change, and they may already change the website, so I'll have to change the slide. Stock patterns are cyclical. I feel like a broken record. And this is the ultimate time, the stage coming out of ambivalence into greed, when everything is marked up. Think March of 2009. Think March of 2020. Then you can throw darts and make money. Now, the problem is you don't realize that you're in this green circle of greed and markup until it's already run a while. And I know I thought back to a year ago and how much people kept saying the market was ahead of itself. It was not going to keep going. And look what it did. It's also pretty easy for me when we're in a true stage 4 of fear, where things are being marked down and you can be short the market and buying contra ETFs. The hard part is during uncertainty and ambivalence. Ambivalence is easy because the market's just dead and it's not doing anything. But during uncertainty, you can have big moves up, big moves down, and it seems like the goal of the market is to confuse you and make you make mistakes. Every time it looks like we've been rolling over, except for March last year, there's another leg up, and we're in the midst of one of those legs up right now. At some point, I expect us to correct. I expect us to have a pretty significant correction. Just not doing it yet. Well, Monday's a new day, but not doing it yet. And this thing here, I mean, I can't emphasize enough. Look at weekly charts too. I mean, I use weekly charts and daily charts. I rarely bother to go intraday because I'm not looking to make a scalp here or a scalp there. I'm entering positions that I want to swing. And if I'm off 20 or 30 cents, yeah, it hurts my performance, I guess. But it's not anything that impacts me in a big way. I'm buying high to go higher. And if I overpay a few pennies because I'm not timing it on an intraday chart, so be it. Now, your approach has to change with where you are. The problem with being uncertainty is that there's no answer that works for me, especially when we're on another leg up, but a leg up in a market that's getting extended, in a market that's full of risk. So I am in stocks and calls. At this point, I don't put on a lot of Scott synthetics. I may have them, but I'm very careful with them because the risk to the downside is here. I've tried to lighten up the number of positions and raise cash, but I'm not by any means saying I'm in cash. I am in this market, but sometimes I max margin, and I'm not max margin now. Now you look at this and you see a lot of red and energy and mostly green everywhere else. And I think that really does reflect the market, as most of the sectors were up this week. And this is a picture that takes the stocks and the various spider ETFs, starting here at materials, and just looks at green if they're up on the day and red if they're down. It looks like Varian got acquired, so I'm going to have to put something else in healthcare. Let's go take a look at the major market averages in TradeStation and Thinkorswim rather. I want this one. So if you step back and you just look at the dailies here, everything on the top, NASDAQ, E-mini futures, NASDAQ futures, Dow futures, even Russell futures, although Russell futures less so, are lower left, upper right hand corner, just showing you the wonderful move we've had over the last 52 weeks. Notice the balloon on the E-minis, the NASDAQ, and the Dow futures is on the last bar of the day. And what that is telling you is during this period of time, that is the highest price of the last, on this chart, which is 52 weeks. The lows on all of them, including the Russell, are the far left, coming out of that March 23rd bottom. The Russell is different that the Russell has not got a new high yet. You could see the VIX has got a new low, and the dollar is sort of in the lower part of its range. So you can't not be a little bit bullish when you see that, of course, until it stops. So looking at it closer, we've taken out the 162 whatever percent retracement, or not retracement, but now expansion. This is a place that I thought we might be troubled with, but we blew right through it on Friday. This is the E-mini futures, new closing high, new all-time high, 17 above the 50, above the 200. Yes, we're getting extended. That's the worst thing I can tell you about this. Other than that, what a beautiful market and what a beautiful time to be long. At least it was up until now. NASDAQ futures, again, very similar picture. The 17 crossing above the 50 here a little bit more recently. All-time high, all-time closing high on Friday. Dow futures, broken record, good alignment of the moving averages. Yes, getting extended. All-time high, all-time closing high on Friday. Wow. Russell looks different, but it doesn't necessarily look bad. Notice the Russell had this just massive move in here, and it's gone sideways pretty much since February. It's been in a relatively wide box, but it's gone sideways since the beginning of February. It's in a buy signal, closed above the 15. The 17 looks like it's about to pass above the 50. If the Russell joins the party, we should have a nice couple of weeks for growth stock investors. Certainly not a bearish looking chart. And if I had to say, do I think it goes higher or lower? You probably can guess I would say higher. VIX, it's kind of getting down to where it's been prior to the February, March of last year. It's been elevated above norm for quite some time, which was bothersome. But you can see it's come down and it's at the lowest of the year. And then the dollar, we talked about it running up and that would be bad for the markets. And it had a reversal here, a low close doji. It's now pulled back to the 50. So is the dollar going to be trapped between the falling 200-day and the 50? That's probably okay for the market because that's within a limited range. Or is it going to break down below the 50? Probably okay for the market. It doesn't look here like it's got a big jump coming in a rally, but that would not be as good for the markets. So that's the daily charts. I look at the weekly charts, just look at them very quickly. And you can just get a sense of how these markets have run up. Here's the 178% extension at 43.58. 150 more points on the E-minis. That might be a reasonable target. The NASDAQ, weekly, new highs. Dow, new highs. And as much as I'm less positive, kind of, sort of, because it's going sideways of the Russell, not at all bad looking chart. And you could see what I said, that the VIX is starting to get back to where it was before the last major correction. And then the dollar struggling, which is good if you're a stock investor. All right, that was good. Now, the other thing that I like to look at in Thinkorswim that you probably have seen some of late, and I think others have started figuring out that there might be value in it, is the expected move chart. So we'll show you how orderly the markets were last week. The E-mini, remember, the expected move starts at the close on Friday, and then it looks at the options maker, volatility, and the cost of a straddle, basically for the next week, and sets a high and a low. Why is that usually accurate? Because the option makers have the edge. They're like Las Vegas, the market makers, and they're setting a price that they feel comfortable at that they're likely for the stock market, odds are will end within these two lines, the red and the green, which means when they're selling a call and selling a put at the same strike price, they're getting enough premium so that as long as the odds hold and it stays within the range, they make money. Kind of why it's hard to make money on one of those trades outside of perhaps earnings season, unless you're selling them. You could see that the NASDAQ, the E-minis, Monday, Tuesday were up days. Wednesday, it pulled back a tad, but not very bad. Big move Thursday. Friday, pulled up to the top and stalled. You look at the NASDAQ, same exact story, except look at these three bars. Monday didn't do much in the NASDAQ. Tuesday was a great day. And then Wednesday, we gave it all back. Thursday, you had almost an opposite and equal. And Friday, you closed just below a doji on both of these, just below the green bar. Dow futures, exactly the same pattern, except their bad day was Tuesday. You look at the Russell futures, and unlike the last couple weeks ago where they blew through the bottom, the last week up, total range bottom to top 2 weeks ago, blew through the bottom last week. Here, kind of range bound, didn't do much at all this week. The VIX down towards the bottom of their move, as was the dollar. So how did this help me this week? Didn't really do much for me. Pretty much tells me we had a relatively orderly week where the markets behaved the way the market makers thought they would. That's okay with me. All right. What's underneath? Rates eased. You can see the 10-year and the 30-year another week down. Falling rates should be good for REITs, MLPs, utilities, dividend payers, and home builders. Rising rates good for banks and insurers. The funny thing is I think the easing rates here, because the market spooked technology, was good for the NASDAQ, especially the big cap. Now, AD lines higher. I think I'm still calling some large cap divergence, and let me show you why. Here's the high cap 1000, basically the Russell 1000 in white. You see the AD line, all-time highs, and whatever color this is, orange, all-time highs on the index. Here's the small caps. We're still not yet at all-time highs on either the AD line or the index. So in my mind, I'm just going to call that a little bit of divergence on the small caps. If I look at the NYSE all-time highs, and everything in this pile here of these major ETFs are up. The thing that's lagging in orange is the Russell small caps, and even the bonds turned up this week, I'm sure because of the softening in interest rates. Now, breadth remains strong and short-term overbought conditions eased. You can see stocks above the 200 are where that arrow is, and we're going back here a number of years. I'll tell you how many years. Going down to the turn of the century. So we are still up in the extreme areas, although not the super extreme as up here. So I've wondered, actually got some answers from some online education this week about how bad is that? Stocks above the 40 have eased a lot. So the short-term overbought has improved. The 3-month new high, new low, which to me is still very interesting, that whenever I get up and reverse near the top, I pull back or go sideways in the market. And we've come off overbought. We could get overbought again very quickly. And more comments to follow on the impact of new highs. Daily McClellan, there's still divergence. Higher highs, lower highs on the oscillator and the summation index. I guess the fact we're positive is good on the oscillator, but we still haven't taken out prior highs despite price. Weekly is the same thing. The buckets, take all the stocks in the S&P 1500 and ask where do they fall within their Bollinger Bands. 81% are above the midline. That is extremely bullish. Now, markets like to stay in an uptrend between their upper band and the midline, below the midline and above the lower band in a downtrend, or above the lower line in a downtrend. This is very bullish, and the fact that I've got very few stocks, less than 10% above the Bollingers, we can keep on going. Hindenburg omens, we would not expect to see a Hindenburg omen. The cautious sign that I see here is we're at 19.66% of the stocks in the NYSE are at 52-week highs. That is kind of massive. And it's an outlier number. When we've gotten this big before, we've seen some sideways moves or pullbacks. Not saying a collapse, but the NASDAQ, the NYSE is ahead of itself. The NASDAQ's only 6.33. It could get a lot higher. So maybe we see some outperformance by the NASDAQ to allow them to catch up. Market tone, the Woody indicator, the major indexes here, all green. That's bullish. Now, it was a weird week. I made money. I made more money than it looks here. Here it says I was up 0.28. That's because my filtered buys, which are the new stocks I took, were up 2.26%. But leaving that alone, when I look at the percentage versus gain versus ERG being EPS rank plus relative strength rank plus group rank, remember this gray line are the number of stocks. I throw out the head, I throw out the tail because there's so few stocks. It looks pretty flat. Not necessarily a good week for growth, but not a great week for value either. And if we look here at EPS rank, relative strength rank, it's hard for me to say a story's here. I mean, in fact, relative strength was negative. Here I took every weekend I create a number of lists. These lists are on the right-hand side. Some of them come from IBD with their Market Watch and their IBD 50, Michael Scott's Focus 3. Some of these are from TradeStation, sells, buys, trilogies, etc. Some come from HGSI. And basically, I try and understand what's working, what's not working. And what I saw this week was that the S&P 500 was up 1.4, the IBD 50 was up 1.43. Hence, you should have pretty much consistency between the broader market and growth. My best group was the filtered buys. The IBD 50 Market Smith up a little bit less than 1%. So a positive week, just not a very big positive week. At the sector side, things look really strong. Here is the Woody indicator for the US S&P sectors, and you can see the only one that doesn't look great is going to be energy, which is yellow. Now, if I go into the Q Edge tool, here's where I do some top-down trading during the day and after hours. I can see that on Friday, the vast majority of these sectors were positive. I think it was 10 and 1. Industry-wise, a little bit over 75% were positive, and 68% of the stocks in the market were up. So that was a positive day. If I look at over 5 days, even a little bit more positive. In fact, if we look at sector performance over the 5 days, everything was up, including energy, which was up just a teeny bit, 0.13. Over the last month, 9 and 2, last 10 days, 10 and 1. So even though it's been a grind, the sectors for the most part have been positive. Now, what I do during the day in Edge is I find which are the leading sectors on the day. Now, if the market's open, this will be populated, and this would be 1 day ago, but since the market's closed, 1 day ago was the last market day. So I just ranked them, and these are the 11 major sectors. We could see here 10 were up, 1 were down, and you could see periods of time 2, 5, 10, 1 month, 2 months, all the way up to a full year. And one thing you can see is materials have been blue the entire year. I mean, they'll have days that they're down, but materials have been strong, and they were the leading group here. Discretionary was second, financials were third. So I highlighted those, I hit the gears. And when I do that, I open up all the different industry groups within those gears. Now, these are being populated, the sectors and the industry groups, not by the S&P 500, but by the 1500. Then I highlighted the industry groups that were above 140. You only have 147, and 1, 2, 3, 4, 5, 6, 7 of them were there. So you've got all except for one made it to this list of the top 8. Now, if I hit the magnifying glass, I open up the stocks in those industry groups in the S&P 1500. And then my favorite thing to hit as far as a macro are these 3 stars, which brings up what we see down here, a list of stocks. And I know Meritage looked good. That made the cut as good earnings and undervalued stocks. And during the day, I shopped from that list constantly by dropping them into TradeStation. Now, I also closely followed my canaries, which are really Ian's canaries, as came out of a 2013 Ian meeting. God, I miss Ian. All of us that knew him miss him as well. And what I said is we made it above their moving averages. So we've come off the bottom nicely. And that, are we setting up an assault on old highs? I think we may be. Look at how relative strength has also improved. Know your news and earnings. So we don't have much news until Thursday when we get some jobless claims and leading economic indicators. And then Friday we got the PMI. That may be interesting. The market seems to go up whether the news is good or bad of late. And that's probably because of the Fed put. And until the Fed starts saying they're going to start to tighten because the economy and employment are strong, we'll probably have that put in place. On the right, you can see massive week of earnings. Last week, earnings season started. Next week, some of the big cap techs will start to come in. But you can see here that there's plenty to watch. It's important because I can already see on my buy watch list are several things that have earnings as well as several things that I own. I mean, I'll have to decide what to do, but I own Cleveland Cliff, AT&T. I own Nucor. So I'm going to have a busy Thursday morning, so I need to remember that. Boy, Chipotle's been a nice performer this year, hasn't it? Even though you wouldn't be eating inside. Netflix, J&J. Big week. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your earnings date is scheduled. So, I'm a glutton for new information. There's a guy named, I think it's J.P. Parrots, or J.C. Parrots. He has a company called allstarcharts.com. A year ago, late March, they had their Chart Summit 2020. And I have to say, part of the reason that I made so much money last year in the markets, several 100%, was because I listened to that summit and I came away saying, buy, 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 because I was convinced by the one after another of the leading analysts that he's friends with that came on, market technicians, who talked about their interpretation of the market. It happened again yesterday. Coming Monday, I believe he's going to have the videos posted. His website is allstarcharts.com. If you Google Chart Summit 2021, there were some really good ones. So I'd asked him in the past whether I could show his charts on my videos, and he said yes. I'm a subscriber. I pay to subscribe a lot. It's one of the more expensive subscriptions I do. But I took some snapshots. So again, I point out these are snapshots that told me a story from the Chart Summit 2021. Strategist, this is one of his first speakers, talks about performance first and second year after a bear market low. I think we can all agree that we had a bear market low on March 23rd, 2020. You can see how few bear markets we've actually had since the 50s. But you could see the first year off the low is always a great year. Again, so my multi-100% year isn't that great, all things considered. But in every one of these, the second year off the low was positive. Now, we're already up 14.6 on the Russell this year. The Dow's up 11.75. The S&P's up 11.4 and the NASDAQ's up 9. So it's very possible that we could go sideways the rest of the year and still be right in the average return. But this other column is the column that we have to pay attention to. And that's every one of these years there was a significant drawdown or a drawdown. Now, have we already seen our drawdown? I don't think so, because that drawdown came before the end of the first year. And look at the drawdowns that are sitting here. Minus 17 after the bear market low in 2009. That was a great bull run, but you still had a pretty big correction. So the message here was, I expect a positive finish for the year, but don't be surprised if we see a big drawdown. Another way of looking at it, what happens after a big rally? So here is a list over the last 75 years, also from strategists. These are all institutional companies, and they don't really sell anything to us. But here are the best 12-month rallies. The one we just came out of, being right here, March 23rd. Here's the 250-day or 1-year performance, 74.9. And then it looks at the next up to 65 days, 125 days, and then 250 days. And what does it show? It shows that at the end of the next year, 90% of the time, only the 1983, after the 83 rally, the market was higher a year later. So just because we had a huge run doesn't mean we won't go further. But it also shows that getting there were pretty significant drawdowns. So whether we look at year after a bear market, the second year after a bear market low, or rather the first year after a 12-month major rally, all show pretty positive 1-year performance and pretty significant potential drawdowns. What about overbought markets? I wish I could get this guy's research on a regular basis. If any of my viewers get his research or research from strategists, you know how you can make me happy. Anybody gets Craig Johnson's research from, not from Wood Mason, from, what's it called? Oh, I'm having a mental block. Mostly a Piper Jaffray. It's got a different name, second name now. Please reach out to me. I'd love to get a copy of his research. But this asks the question, just because we have over 97% or 96% of the stocks in the S&P 500 over the 200-day moving average, is that a bad thing? Well, look at all the times that we've hit this high percent above. Market keeps going higher. So this is good overbought. You can get corrections or consolidations, as I talk about often, but it's hard to see a top with this broad participation. This came from a woman that works for JP or JC. I have JP as my captain, JC is the analyst. JP, the captain on my boat that I bought with my winnings. But you could see US, Germany, you can look throughout the world. I could have put Japan here. Everything's at all-time highs. Where's the bear? How about defensive plays? Here's performance of bonds to spiders. When it's down, that means the market is not defensive. Gold, which is defensive versus spiders, new low. Yen versus Australian dollar, defensive as the yen, new low. And the Nifty 50 versus the small cap, the Nifty 50 being more defensive, new low. So these are relative strength charts showing that defensive postures are at all-time or at new lows. This came from LPL Research. Their lead analyst presented at the meeting. Whoever said stocks don't like higher rates lied to you. Rising rates start and end date, duration, the change. Some of these changes were pretty big. And maybe it's just because markets usually go up. But even with a higher 10-year yield, the average median return was 15 to 17%, and markets were up 78%. So next slide is something that I want you to remember. And it's a slide where I had an aha moment because I learned something new. And this is the kind of thing that Ian would have taught us. The December low indicator. Before we even talk about what this is, notice that 94% of the time, going back to 1950, when this indicator is positive, you had a positive return on the year and averaging between 17 or 18%, which is an outsized return. So what is the December low indicator? On your charts, draw a horizontal line from the December low. Draw a vertical line at the end of March or the end of the first quarter. And if the price of the stock does not close below that horizontal line in the first quarter, meaning you do not take out the December lows, then you have met the December low indicator and you will have most likely a positive return. Breadth, thrusts. I heard a lot about thrust. There's a guy named Mark and his wife Kathy Shavako, and they're money managers in Atlanta. CCM, I think is what it's called. And they do a wonderful video every weekend. And he spends a lot of time talking about thrusts, and especially thrusts where you go from oversold to overbought in a short period of time. And he might look at the most recent one and say if it was, let's say it was 260 days, then he would do a rate of change with the 260-day periods and look for other times in the market where we had similar outcomes as this one. Well, here's another way of looking at thrusts. So these are thrusts when we've gone from very low to very high. They've only occurred 3 times since 1990. And the question being, are these thrusts in market breadth bearish or bullish? If you look at the one occurring in 2003, 2004, the market was off its lows for over a year in the middle of a run. You got a thrust, and yeah, there may have been some backfilling, but we continued going higher. If you look at the thrust that came in March of 2009, yeah, there were small pullbacks, but boy, we went one of the longest bull markets ever. Well, we just got a thrust that came in last week. We got another bullish signal, folks. So, market thoughts. Each of the large cap indices rose more than 1% in this news-heavy week. Earnings season has started in earnest. Higher than expected CPI, strong retail sales did not spook the market. Interest rates actually fell as bonds had an oversold bounce. This led to some improvement in big cap tech. My account ground higher on the week. I'm sure yours did as well. I still think that if we're going to see that pullback, what better time than May, June timeframe. So I'm continuing to roll options up and out, taking profits, paring back the number of positions. I am up a lot on the year. At least 4 times the Russell, 6 times the NASDAQ, so I'm happy where I'm at. I remain cautious by nature, but if I had to guess, we're still in the latter part of the beginning of this run. Corrections occur, but my guess is we continue to grind and at times melt higher. There's the returns year to date. And, this is something, the last comment is sort of adapted from something that Mark Shavako says. Be open-minded to greater than expected returns over the next year, but that does not mean we cannot see meaningful corrections. He says the first part, I added the second part. All right. Again, on Monday, this should be posted. It's worth watching, especially the analyst sessions. Chart Summit 2021. Highly recommend you check out allstarcharts.com. Do a 1-month free. He does some great webinars, publishes his slides. He uses a company called Optuma, which is great for relative strength comparison charts. I've learned a lot from him over the year. And I joined because I learned a lot last year. All right, let's jump into Let's look really quick at TradeStation if it hasn't kicked out on me this week. I like looking at the indexes the same way. Let's go to the E-minis. Now there's about 6 things on this chart. First, this is daily, weekly, and monthly. These are the S&P futures. Number 1, are we in a buy signal or a sell signal? We're in a PPS buy. Number 2, are we green or blue? We went blue on Friday. Blue is an Alexander Impulse indicator. Green says buy, 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 or hold. Red says sell, 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 or hold. And blue says you can do whatever you want. So it's blue, green, and green. So we're in a buy on 3 time frames. We are mostly green, but short term we're getting a little overbought. It's blue. These red dots tell me that I've got MACD divergence. It's interesting because that MACD divergence, looking at it for me, is really looking at from here down to here is clearly lower, while here's higher. So if there's one thing that I think is pretty easy to learn on this chart. MACD divergence goes on a long time before the market corrects. I've got it on the weekly, I've got it on the daily, so that's a little concern. I'm riding above the upper envelope. That doesn't last long, so another reason why the E-minis, all I got to do is go sideways. They don't have to collapse. If I come down here, no surprise, I am weekly bongo is green. And for those that have followed me for any length of time, when I see a high jump of 98% on the E-minis, tells me E-minis are going to pause. They may not pause on Monday or Tuesday. They can get even more overbought. But these things are at a point where I expect a pause. Let's look at the Dow futures. They're green. They're at 95%. I'm not even going to bother. The story is the same. They need a pause. The Russell futures, different. A new buy came in on Thursday, green, blue, green. Buy signal on all 3. No MACD divergence because it's not at a new high. 43% of the high jump. The weekly bongo still red. This one's got work to do. Then the NASDAQ futures, also above their envelope, but no MACD divergence at 69%. Is it 69? I got to put my glasses on. Those things are so small. You should see how small they are on 5K, and I just ordered my first 8K monitor, 59.56. NASDAQ extended, yes, but not in high jump territory. So I'm more concerned about the big caps. No shocker, they've been leading. All they have to do is slow down and let the small cap guys in the NASDAQ catch up. I'd be a happy camper. The dollar, just for a quick comparison, red, strong downtrend, daily downtrend, weekly downtrend, still up in a monthly. Red bars can still get lower. So caution signs, but one thing I've learned over the years, extended markets can get more extended. Let's go into HGSI. I've looked at the Major Markets Plus, which is a Ron Brown group. Top-down view, 35 instruments, and the leading was 400 miners, utilities, small caps, gold, NASDAQ. So sort of an interesting week where you've got gold and gold miners have just made it up there. The fact utilities are up means it must be a tough time in the market, yet so is the small caps and mid caps. So, and the Russell's number 10. So I'd say it's a confused market. Maybe some rotation of gold. We shall see. First, I started with a broad look. Here's that 161, 162% retracement. We took that out on the S&P this week. Here is the March lows. You can see how far we've come. When you look at the S&P, not quite at the high jump, but pretty close. Here it's telling me 84.6. So it's interesting. It's different. The calculation should be the same in both of them. But this one, well, one's futures and one's the S&P cash, and that's the difference, I guess. All right. So very quickly, we've taken out the fib. Beautiful uptrend. Is this a climax run melt up? Look at it over here on the weekly. This was what we were running up. Now it looks like we're running up like this. So are we in the midst of a melt up? You know, obviously you can answer that yourself. Clearly we have a increased acceleration to the upside at the minimum. This too will end. You ride it while you can. Dow Jones Industrials. Not quite the big upturn as the S&P. Beautiful uptrend. Intact. Nothing new to say. The Russell. It's above the 50. Look how crappy relative strength is compared to the S&P 500. Of course, S&P 500 is up here. And then lastly, the NASDAQ Composite. Not quite to levels of the S&P, but looks very positive. All four of these, just as I've shown you in TradeStation and Thinkorswim, all look bullish. The concern being, at what point are we overbought? And on the large caps, especially the Dow and the S&P, it looks like we're in that vicinity now. Not saying we got to roll over. IBD 50 probably reflects most of our portfolios, just riding the 50. More bullish, in my opinion, than bearish. It's come off its bottoms, but it has not, in any factor, broken out. Biotech, I thought maybe this would have been the week as it bounced off the 200. It ran into the chandelier and paused. We'll see if it, you know, it's got some work to get above the chandelier, the 100-day moving average and the dashes, and then the 50-day. A break above the 50 would be very bullish, but it could just as easily come back and revisit the 200. Semis have been big leaders, sort of a sideways week. All right, what else would I look at here? You know, I'm not bashing Kathy Wood. Obviously, she did extremely well. She bought a bunch of Coinbase, so that probably says good things about Coinbase. But let's just look at her ETFs. Under the 50. 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 What's the message there? It's hard to make money all the time, especially when you have thematic investments, and each of those have a theme, and those themes go negative. Bitcoin, not exactly a tight chart, but boy, if you bought it, there's a Bitcoin Trust 12 up to 56. It's pulled back a little bit here. Still amazing. Let's look at the dollar. Failed at the 200, pulled back, sitting in the 50. Bearish more than bullish to me. The VIX, we already looked at, doesn't show up very well here because it's so destroyed. Gold's showing some activity, a couple of pocket pivots, a down person buy signal, mobile breakouts out of a squeeze, popped above the 50. A lot of work to do to get above the 100 and the 200-day moving averages. A new buy on the weekly. Gold looks okay here, doesn't it? Maybe this is gold's time. Silver, about to break above the 50. But what's been working the best, and I bought Barracks not long ago, probably will add to my gold miners this week if it can break above the 200. The gold miners look better than gold or silver. But, you know, they have some resistance overhead. Now, someone said there was a bull flag here. I'm looking at this. I guess, is this the flag here and we broke out? Or is this a bear flag? We'll see. I think gold miners are stirring. Who knows how far they're going to go. And lastly, commodities have broken out. And probably the biggest commodity that I use is oil. And oil here doesn't look like much, but 18 to 42 in the last 7-8 months. Do you remember when oil you could buy barrels for less than zero? They paid you to take their barrels. How fast the world changes. Jump over to industry groups, 174 groups. 2-day up would be 64 versus 2-day down, 12. So decidedly bullish on the underneath, looking at industry groups. I want to point out who's not bullish. Biotech, internet-based services, exploration production, life science, internet media, infrastructure software, medical devices, midstream, and apparel. Most of them over 5 days were either positive or close to positive. Maybe that's a 1 or 2 day rotation out, but those are growth stocks. Hence, if you got hurt this week, I can understand why. 5-day down, 34, 5-day up, 63. So positive tilt, let's look at to the upside. So in HGSI, one of the beauties of HGSI is I've ranked here by combo rank. This is my 2-day force. So old, probably Ian's 2-day force. So I'm looking for momentum. If I highlight something and I right click, then left click, change the index group, the stocks in the group come up. If I double click on that, it shows down here. And then I could go through by clicking the arrow one at a time what's in that group. Now, typically, I only go and look at things that are outperforming the index. Workhorse is a maligned EV truck manufacturer. I think they ousted the CEO. He was very promotional. He touted all these pre-orders. And then you have these people that really didn't have a business saying, yeah, he asked us to commit that we would consider buying. There's no firm commitment. And then the stock cratered. It's sort of bottom fishing here. Kahunas, pocket pivots, move up on Friday. I don't chase this. It still looks like garbage. I'd leave it alone. As I go through, Cummins, old standard company, in a saucer here off the 50. If it took out this, its chandelier stop, that might be interesting. Allison broke out already. All right. So this is what I do. Next one's renewable energy. Now, these were old leaders that got clobbered. They're still clobbered, but let's see what we see here. We see stocks. This is run. Do I want to buy it down here? No. But I'm going to pay attention because I'm going to show you a collection. You had a kahuna and a pocket pivot and a positive move on Friday. DQ, big winner, then a loser. It's come back and filled the gap. Unfreaking believable. And it's moving off of here. 2 pocket pivots. Big volume came in on Friday. Mobile breakout from a squeeze. Would it surprise me for it to go higher? Absolutely not. Look at the earnings per share growth. Under demand. Would I go out and load up the farm here? No, you still got a ton of overhead supply. You got the 100-day. You got the chandelier stop, and you got the 50-day overhead. But maybe there's a theme coming. For solar, is it done going? Canadian solar, a lot of new buy signals. So the question is, and here we're looking at the index, is solar done going down? And do you just buy the solar ETF, TAN? I like DQ. I like Sunrun. There's some stocks here that I've owned. For example, Enphase. I'm out of all of these because I got clobbered. Enphase, is it done going down? I don't know. It's going sideways now. Solar Edge, pulled down to the 200. Look at how these were great leaders, but look how they went from tight to very loose to breakdown. Ballard Power, fuel cells. Solar Edge. These are all beaten down. They're all at positions that look like where things bounce from. You don't buy them because they look like they're in positions where they bounce from. You watch them. Precious metals, no surprise. I own Barrick. I hate to get excited and say it broke out this week, but it broke out this week. It just didn't do a whole lot. You can see it on the weekly as well. Good earnings per share growth. Probably the best of a bunch. It looks like Newmont. Newmont actually broke mobile breakup from a squeeze, a new John person buy, pocket pivots, and kahunas. This is on my buy watch list as well. Then you get the index, I believe. And then some AEM looks interesting, but these are all down the lower right-hand corner. Wheaton, AA. Interestingly, where usually it's the small golds that look like they're leading. It's a big gold that looks more exciting. Newmont and Barrick. Semiconductor devices have been super strong. NVIDIA, wow. Wow. You know, it's not a cheap stock, multiple of 78. It based from September until the end of March and broke out. Wow. Too late for me. Wait for a pullback. Lattice Semiconductor, Bible Gap up, AMD. And wants to go higher. Just had some upgrades to about $100, which just gets it back to its old highs. It's just struggling to get out of this congestion area. Qualcomm. So I just see a lot of stocks that it did well that aren't doing much right now except for Lattice and NVIDIA. Large pharma, safety perhaps. You do have to respect what they did in getting COVID viruses out. Pfizer, here's the problem with Pfizer. These are in millions. So it's got 5 billion shares out. Its market cap is 215 billion. It takes a lot to move Pfizer. Sideways player, the 9.1 is not correct. It's closer to 3 or 4% on the dividend. BMY, I mean, these are not growth names. J&J, Lilly, Glaxo. The only one I really like is AbbVie. And why do I like AbbVie? Because AbbVie pays a dividend of 4.6%. It has stayed relatively flat during the last couple of weeks with some chopping around. But it has growth prospects of a biotech. Look at the growth in revenue. And pays a dividend like Big Pharma. All right, continuing on. Home builders have been on fire. I've just been playing the ITB. Horton, all-time highs. Big run, probably too extended, but great earnings per share growth continues. Down here, houses are crazy. Lennar, sideways move, maybe a chance to get in when it breaks out of that. Great earnings per share growth. Toll Brothers, Pulte, KB, breaking out here at about 50. Here's the index, and like I said, I played it by buying ITB, which looks just like the stocks. And I'm comfortable doing that. I don't have individual news risk. I think MTH and MT is one that made my list. Why? Because it's coming out of a consolidation. It's expensive stock. It's still a $100 stock, but it's not as extended as the others. Number 7, home product stores. Home Depot. Last week I said I couldn't buy it. It's too extended. It got more extended. I still can't buy it. It's too extended. Look at this move on the weekly. I like buying it coming out of bases. It may go to the moon, but it's going there like Elon Musk without me. Lowe's Computer, the same. Restoration, I buy it off the 50. I took my profits. Maybe I should have kept it. Beverages, boring, staple type of a group. PepsiCo breaking out of a handle, maybe. Monster broke out. Not groups I typically buy. Constellation Brands, sideways move, breaking out. If you want something more defensive that pays dividends, beverages. Consumer finance, they're all getting into Bitcoin. Visa, if I want to be bullish, it's breaking out. If I want to be bearish, it's gone sideways since September. And it's at the high rate area of its range. MasterCard, same story. Amex, a lot of growth, sideways move. Perhaps this is a good place to be looking at it. And lastly, in the top 10 were diversified banks whose earnings have started. Wells Fargo looks interesting here. It's still way off its highs, although it's had a big move off of its lows. It seems to have gotten over its controversies. It pays a 1.8% dividend. It's got great earnings per share growth coming, although this was the one that just came out. This is the next one. But even JP Morgan, which is a really expensive stock, is probably at a good buy point. Earnings are out. They didn't get hurt in the Archegos debacle. So I do this every night, the top 10. Other things that I do is I look at some of my favorite smart groups, which are updated. Free parking with momentum would be one of those groups. This week I went through, I looked at my 1,000 charts, just give you a sense of what I found that I liked. Go to buy watch. Sure you can't hear it, but my dog has had enough of this. He's lying next to me snoring. Wonder if he's trying to tell me something. So, I look at a lot of stocks. That's what I do on the weekend. And I try and find a couple that I want to play. These are the stocks that made it to my list. And then I'll probably spend the rest of today looking at them and maybe picking a couple that I want to play this week, at least play on Monday. You could see agricultural chemicals. I'm in Mosaic, but SQM and Lamb Weston on the agricultural side and Bungie looked interesting. There's a couple of application software. Cerner looked good on a couple of projects. Pullback just broke out above the 50 and 200. Big volume pocket pivot. The weekly bongo turned green. MyTech, smaller application software, been in a downtrend, stuck its head up above its chandelier on Friday. Mobile breakout from a squeeze. Pocket pivot, Kahuna. What's not to like? It's in a downtrend. Similar picture, Tenable Holdings. Big pullback, broke above the 50 here. To me, it's not a bad place to start a holding, but it's also not without risk. Western Alliance Bancorp, big run up, sideways move, broke out, took out the chandelier stop, mobile breakout from a squeeze, pocket pivot, Kahuna. Now this was a big move. It was a open, high, low. That was almost a 10-point range. So your stop's going to be kind of far, but I love this pattern. Pays a small dividend. Constellium is in the mining space. Sideways move, broke out on Friday. If I had to buy a biotech, I'd buy Novavax. Remember, I compared Novavax's market cap at 16 billion to Moderna, which has come down, but is still 68 billion, which is just ridiculous, by the way. And I think that Novavax still looks good right here. Altice is a communication satellite, good earnings per share growth. Pulling back, just stuck his head above its chandelier, a couple of kahunas in a row. I always pay attention to that. DaVita Healthcare Providers, don't know much about them, even though I'm in healthcare. Sideways move with a breakout. Mobile breakup from a squeeze. It's in a person buy. Pocket pivot, 2 kahunas in a row. So there are a lot of nice looking charts here. Middle B, interesting stair steps. Base, base, breakout, base. Are we breaking out? Mobile breakup from a squeeze, person buy, pocket pivot and a kahuna. Industrial stock, I like that. Let's see if anything else that I wanted to show you. Lumber's on fire. Here's a way to play it as Weyerhaeuser. They own forests as a REIT, pay a small dividend. This company has some fleas in the past, but Lumber Liquidators has got to be on fire with the housing and all the need for wood products. Mobile breakout from a squeeze. Now, I actually love this pattern. Let me say it again. I love this pattern. Here's why I love this pattern. It opened at 26.52. It closed at 27.47. The low is at 25.60. The prior day low was at 25.52. Before that, 25.52. That's the same day. 25.55. All right, so I don't have to go below 25.52 for my stop. So it's still a pretty big, it's a $2 risk I'm taking. But here's a stock that's gone sideways. You can see it's been squeezing now for a month. Yes, it's had multiple mobile breakouts during this period of time. It failed here at the 50, but it's now sitting on top of its moving averages, and it's really got the mobile breakout squeeze, the pocket pivot, the kahuna. So if I was to play this, and this is for education only, folks, oh, I just didn't do that, did I? Here's my box. I would set a buy if it takes out the high of yesterday, and that high was at 27.54. So I'd almost put a buy at 27.55. Stop at 25.50. I think it was 25.52 was the low. And that should be this box. Now, if it's, I don't want to buy it until it breaks out of this box. Here's the industry group strength. All right, this is an attempt at relative strength in blue. If you look at the relative strength of Lumber Liquidators here, it's at a relative strength rank of 95, which is pretty awesome. I like this. That's how I would play it. But it's got to get out of the box, and I would let it fall back into the box before I got stopped out, but I would not let it fall beneath the box. We looked at some of these. All right. Now, lastly, let me just go through the canaries, and then we'll say goodbye. I think the canaries may be interesting for a while. And these are extended canaries, as you'll see, as we put together years ago. Adobe. Adobe is pretty much, if if you look at just the bodies, is about to break out of its box. It's already moved a lot, bullish, but I'm not chasing. Alibaba, it got tied up in that hedge fund blow up. You know, it seems like things are getting better there with Jack Ma. Chinese slapped them 2.5 billion times. Is it ready to run again? It's not looking like it yet, but it probably will. Google, we talked about it 10 days ago. What a great buying opportunity here. How many of the stocks I showed you today look like this? Pull back into a major moving average, mobile breakout from a squeeze, pocket pivot, kahuna, and a breakout. It's already going. I probably wouldn't buy it here. Amazon. Here's a box that I drew quite some time ago on Amazon. Amazon is one of the stronger stocks right now, although its relative strength rank over is only 49. It is right at the top of its box. One has to assume that the least amount of resistance, even on this weekly chart, based upon how it's been performing, is for it to fall back into the box. However, if it goes higher and breaks out of the box, it'll run into earnings. And it could run another 100 points or more before earnings come out. Earnings on the 29th. So Amazon, I am in, and I'm cautiously optimistic. Apple, run up the week before, didn't do much this week. More bullish than bearish, but I'm not that excited. It does have a new event, probably touting some new iPads coming up. Here's the index. Facebook, big run up, install. Microsoft, its application software technology, off the lows from 130 something to 260 something. Microsoft, a double in a year. Yeah, I own it. I continue to own it. Again, after this big run, a little consolidation wouldn't surprise me. Netflix has earnings coming out. So one thing I might do is call up Seasonal Trader, which I don't think he watches my videos, but maybe Eric responded to all my complaints about not fixing the broken links on the earnings and options and the scanning, because it seems to be working now. Let's open it up. Let's take a look at Netflix. All right, I got to change one thing here, configuration. So here's Netflix seasonality. It's a mess right now. It doesn't seem to get good again until June, when 8 out of 10 years are positive. I look at this and say, I think I would pass. I certainly wouldn't be buying Netflix because of season. Then continuing in my extended FANG, NVIDIA looks great, but maybe too late to buy. And Tesla, probably one of the most overvalued stocks out there, with a PE of 1174 that probably is going to go higher and retest its highs. That's how my take on the market. Look, you look at the spiders. It's very hard for me to look at these charts and be bearish. Sometimes you don't realize how good you've had it until it's gone. I'm not talking about your love life. I'm talking about the market. And with all the complaints and concerns and the big day ups and the big day downs, this market continues to grind higher. So I highly advise that you go and watch the videos from the All-Star charts. In fact, before I say goodbye, here it is. I'll bring this over here and tell you some of the best ones. I mean, this guy's got his just like I have my way of doing things. He has his way of doing things. It works for me. It may or may not work for you. Here are the ones you really want to pay attention to. Todd Sohn, Mike Hurley, Rajmi, Straza, Brian Shannon, Delwicki, Dietrich, Capillari, Dunawilla, and one of the best of the night of the day was Ari Wald, and then JC himself. Some of these, like Elisa here, are talking about, I think, Rock the Street. I think it was about a fundraiser for women in secondary schools. Sean is good as well. Brittany was again about women and young girls. Kimmy was mostly off the cuff talk. She's a buy-side, excuse me, she's an analyst rather. Dietrich is the LPL person. I believe Todd or Hurley. Go back down here, let's see. And I gotta get going. You want to get rid of me anyways. Does he even have, yeah, Hurley is that next point, and that means that the other guy, Todd, is the guy for strategists who slides several of which I used today, or I showed you. So highly recommend you do it. Trade safe. Have a great week. Talk to you next week. Goodbye.